the show right now. Steve, hi, good morning. Good to have you on the show. And Steve, I guess it's all about what the Fed is going to do come December. And that's what's keeping the markets also on hook.
I think that's right. There are bigger picture themes that are out there. Obviously, what's happening with AI and risk appetite. But I think the shorter term theme and the theme that the market can wrap its hands around is the question of, whether the Fed is going to be hawkish or dovish. And they've sent out very mixed signals. The rally at the end of the week that we saw in equities, I think was pretty closely tied with the Williams indication, the New York Fed chief's indication that he's leaning towards a cut. It's not guaranteed, but I think, it sort of gave the market some hope that cuts were coming. Just to be clear, we don't expect the Fed to deliver all the cuts that are priced in, so there could still be some angst to come. But I think that for now, the market's taking comfort from those comments.
Going into the Fed meet, you have now the New York Fed president, indicating to a rate cut. You have other Fed officials also, talking about a possible one. What do you think would be the key, driver for a rate cut, given the fact that data is not coming through, and especially for the October data, which will come in only after, I think, the December Fed meet actually.
Yeah, that's right. That they're actually skipping the October labor data. They just weren't able to do the household survey, and so they're going to put out the November data after the FOMC meeting in December. So they won't have that when they meet. Now, there are different views on the FOMC about what you do in that case. Like, some of them say, well, you make your best guess and you act on it. Others say you go more slowly. We'll have to see how this plays out. We will be getting other data. And for example, I think the ADP data gets more attention these days than it ever did before, and some of the other private sector. So, the market's pricing about a 60% chance of a cut, a 25 basis point cut in December. We don't think that it's a done deal. We do think that there's, it's going to be very close, but there's still a lot of data to be received, even if it's unofficial or non-governmental data before that FOMC.
Steve, the other overarching theme has been the risk off when it comes to the tech-heavy names, right? While, of course, there's been a rebound as well, which played out in the latter part of the week. But do you think we could revisit that bout of correction or profit-taking within the tech names?
Well, there's an element that's like tech-specific, which, I'm not an expert on. It's hard enough to follow FX and market, fixed income markets. But there is an element that kind of tracks risk appetite, whether the macro environment is friendly. And we think that should be friendly, notwithstanding that the Fed won't deliver the cuts, because we think that there are some, productivity gains and profit gains that will continue in 2026. It's not that the Fed won't cut because they're mean. They won't cut because they don't have to, because the economy can deal with the higher rate. So we think that, there could be some, good news there, sort of broadly speaking.
How do you see the dollar in that case, Steve? Given the fact that you have a weak labor market and inflation outlook, which is improving from a Fed's point of view, and also if you just suppose what's happening in Japan, the long duration yields are also inching up there.
Yeah, we're dollar bulls, and the market's going our way. Our year-end forecast is 115, so we're not that far off it, and we expect that for the euro, and we expect the euro to go down to 112 by the middle of next year. We think that this, to us, the biggest story out there is the possibility that both sides of the macro balance sheet are correct. That the growth numbers, GDP now is running like 3.8 for Q3. That's correct. The soft employment numbers are correct. And what we're getting is a boost to productivity growth. historically, that's dollar positive. It's also very friendly to equities. And ultimately, jobs recover. It just doesn't happen immediately. So for the dollar, we're actually, pretty positive on it as in the course of the year. And what's happening now is that some of the comments are sort of supporting the dollar, against the euro. I think the U.S., I mean, there's some risks there. I mean, the Supreme Court on tariffs and so on, but I think that by and large, we're comfortable with our long dollar view right now.
Right. Okay. Steve, great to have you on the show today. Thank you so much for your time. And I'm going to quickly take it across to Snehi as well and get a summary of how the global market has been and, of course, the commentary over the weekend.